A lot of us go to real estate as a way to get depreciation and offset our taxes.
Yep.
And I just did not see any real estate deal in 2023.
Greetings, wealth builders. Welcome to Get Diversified, your go-to podcast for all things real estate investments.
I'm Jacqueline.
Melvin Landry. We're thrilled to embark on this wealth building journey with you.
Imagine this. What if your investments not only secure your future, but also unlock a life of financial freedom? That's what we're diving into on this show. Apartment buildings, storage facilities, mobile home parks, the whole shebang.
But here's the kicker. It's not just about investing. It's about crafting a legacy, building memories with your loved ones, and seizing every moment. Time is the currency of life. And let's be real, none of us wants to waste.
We've got the insights, experience, and dash of excitement to spice up your investing game. Plus, we'll throw in some real-life stories that'll make you see the potential in every brick and mortar.
Subscribe, buckle up, and get ready to turn your investments into a ticket to financial freedom. Together, we're not just building wealth, we're building a community of savvy investors. Let's get diversified.
Hello, everybody, and welcome to Get Diversified. I am your host today, and I have a friend, a fellow investor. I'm also a student in her mastermind or her group called Ace Operators, Sandhya Seshadri. So let me give you a little bit of an introduction about Sandhya. So she has been trading stocks for over 2 decades. She has also invested in over 3,000 multifamily units.
3 full cycles. And, I've been invested because I met you through the same group that we all joined for mentoring in multifamily. And that was, I started out like 2018 into this multifamily business. And that's the season that I call the golden era of multifamily, when everything went really well until the interest rates went up.
Yeah, so you have over 140 million assets under management. And you have recently invested or diversified your investment portfolio with oil and gas funds. Mm-hmm. And from what I also understand is you are very passionate about math and financial literacy, and you enjoy travel. So
those are all my favorite hobbies. Thank you.
So cool. Let's get right into it. Let's talk about oil and gas.
All right. So, like I was saying, the golden era of multifamily was phenomenal. You could pretty much do nothing, and just from the interest rates and cap rates compressing all the way until about 2022, early 2022, you could buy and sell a property as long as you sold it by then and make money in multifamily. It was very easy. Even if the rents and all of that didn't really favorably go up, just from cap rate compression, you could make money. But rents also went up significantly in that time frame in Dallas. And so multifamily was the perfect investment at that time. And then
let me ask a quick question, Sandhya, before you go on there. So tell our users, a lot of our users, our listeners are newer and they may not understand what you mean when you say cap rate compression. So tell me a little bit about what that means in your view.
So cap rate basically is the net operating income of a deal, which is what is the income after you pay all the expenses, like you pay your utilities, salaries, and all of that. You collect all this revenue from rent and other income. You subtract from that your operational expenses, salaries, utilities, admin, all of those expenses. And what's left before you pay the mortgage is your net operating income. That's the measure of how well a property is doing, and is that money enough to pay your mortgage and other capital expenses. So that net operating income divided by the purchase price or the sale price of your property, that's what is cap rate. And the cap rate is somewhat dependent on the interest rates going on at that time, but not 100% one-to-one correlation. I would say 30-40% level of correlation. But when interest rates come down, just like if you're buying a single family home, your purchasing power goes up because at a lower interest rate, you can buy a more expensive property. Cap rates kept going down for a while, all the way from 2019, 2020, 21, 22. Interest rates were super low. I remember seeing 3% interest rate. So at 3% interest rate and 4% kind of interest rates, you could buy a lot more for your money. And that's what was happening is the economics was very favorable for sale. So if you happen to sell your property in any of those time periods before the rates went up, you made good money. But that changed once the Fed started doing this very steep interest rate hikes, like 9 or 10 in a row. And that completely choked anyone who had a deal in floating rate interest, because your mortgage basically doubled from 3.5% to something like 7%. And hopefully you had a cap, which would basically limit the max of the interest you would have to pay. You can purchase something called a rate cap. A lot of people didn't buy one, but even those who bought one bought such a big strike that if your interest rate is 3.5 and you bought a 3% strike, that means you might have to go all the way to 6.5%, which your deal may not support the financials to be able to pay such a big mortgage. So a lot of deals crashed and burned, and there was hardly any deal flow in 2023. And that's when I still needed something to offset taxes. A lot of us go to real estate as a way to get depreciation and offset our taxes. And I just did not see any real estate deal in 2023. And then I learned from a friend who was born and raised in Midland and deep in the oil industry for decades, born and raised there. And her dad is in oil, her brother is in oil. So she really is very much in oil. And she's actually a co-author with me in 2 books. And so I've gotten to know her very well over the last 5 years. So when she told me that, hey, why don't you try oil? If real estate, you don't have any deal. Because she was going to invest in my next multifamily deal, but I didn't find one. And then she was doing oil. I'm like, okay, I need to learn more about this. And I discovered that the IRS gives you, the tax code specifies how you get this depreciation. It's actually, one thing is called the tangible as well as the intangible drilling costs, like the cost of all of the equipment you buy just to drill those oil wells and the drilling costs associated with it, and something called a depletion allowance. So just like in real estate, the way you structure a deal, you can structure the deal in oil as well to decide how much depreciation or tax benefit you want to provide for your investors. So all the deals I get involved in, the tax benefit is a big piece of it, because for all my real estate investors who are loyal to me for all of those years, I'm now offering oil as their tax strategy only because the cash flow is also much higher. So for me, my first deal was in 2023. It is now 2025. We're not quite up to the full 24 months since I bought that deal or since I invested as an LP in that deal. I've already gotten most of my money back, like almost 80% of it back. So that's great IRR. That's great cash flow. And the tax benefit you get from oil can offset any income. Because we made some money from taxes. My husband has a W-2. We made some money from, stocks. And then my husband has a W-2. So none of that is real estate related. So it's not something with which I'm going to offset my real estate. It's, you can offset your gains from stocks. You can offset your gains from bonuses you get in a W-2. Anything with oil. You don't have to be a real estate professional. Offset any income.
And is the depreciation 100% like it is in multifamily? Trying to do a comparison. So I know that the president brought back 100% bonus depreciation. So is that the same on oil and gas, or should we be looking at it differently?
It's separate and it's different because it's a different asset class and category altogether, but it's all in how you structure your deal. So a class A multifamily or a particular apartment complex, which is widely spread out and has a lot of acreage and grounds around it, will have less depreciation than something that's densely packed with a lot of buildings, because what you depreciate is the building in multifamily. It's not the grounds and all of the parking lot and all that. So similarly, every deal is different, and also how you structure the deal is different. So in our case, we make sure in oil investments that now I'm a general partner in, we structure it to provide at least 80% depreciation or offsetting your taxes. So it gives you a minus 80K or better in your K1 just for the first year. You do not get it in the subsequent years. But you also don't ever have to worry about recapture. So you know how when a deal sells in real estate, you chase a 1031 exchange because otherwise you'd have to pay your taxes from the sale of that first deal? You don't have to do that here. It's just depletion allowance, tangible and intangible drilling costs. There is no recapture associated with those, like a building that is still standing 5 years later when you sell it. So you can offset any income and there is no recapture. And I'm getting the usual 80% or so from my 100K invested. So that's a nice, anywhere from 26 to 32K kind of savings, depending on your tax bracket. And that's
Right.
the sure thing. Any returns are all projections, right? Whether it's a multifamily deal, a self-storage deal, an oil and gas deal, any future projections are just that. They're just projections. They're not guarantees. But the
Sure.
tax benefit is a sure thing. And so
Sure.
that was enough for me. So I get an immediate benefit, right? I get a 27% or better immediate benefit, net cash to me from tax savings. So that was enough for me to take the plunge. And so far it's done really well. Again, you have to understand the risks. So if you like, we can jump into that topic next as to what
Yeah,
are the
but
risks in every
I
deal.
would love to, right? So this is an area that Melvin and I would like to get into similarly for the tax benefit, because I look at investments, or Melvin more looks at investments, is hey, the tax benefits are the most important thing to us, right? Cash flow will continue to rise, but we need to continue to focus on those tax benefits. And so that's number one to us, and oil and gas is something that we're really interested into. So yes, let's talk about the cons. And when you talk about the cons of investing in oil and gas, I know that you can invest in funds, oil and gas funds. You can invest in individual deals. You can invest in drilling. You can invest in, there's so many. So talk a little bit about that whole spectrum of what the different types of oil and gas opportunities or that are out there for
So it's
investors.
just like you can invest in a fix and flip in real estate where you're buying one single family. Maybe you're funding it and this flipper goes there and you're buying this one, apartment complex, duplex or something and coming back, versus you're investing in a huge portfolio. So similarly with oil, I don't want to invest in just one well. I don't want to invest in the drilling costs associated with well number 1037 in this plot, because what if that ends up being a dry well? So
Right.
I always want to invest in at least 4 to 6 wells. And I like to do my investments where the drilling has already started. So if you imagine a rectangular map, and this entire area, let's call it the Permian Basin, is full of oil wells, and there's already drilling being done by the big companies. Talk about Bakken, talk about your Exxon, Chevron, those kind of really mega companies. That oil is being drilled in that area. So you know for sure oil has already been found somewhere in this rectangular plot. And now you own a small piece of it. Imagine a piece of a puzzle within that rectangle. So we get
Sure.
the mineral rights for one small piece there. And then within that, we might have 4 or 6 oil wells. And so even if one drill produces a lot and one oil well produces a little bit, one produces a lot, you get an average among 4 to 6 wells. And we base our underwriting on that average production number. So I don't want to invest with a small driller, because they are raising just to fund their drilling costs. I'd rather invest with a large operator who's already drilling in that rectangular plot, if you will, already has wells drilling and flowing and showing oil. And so we happen to say, hey, you're already drilling there. Come drill in my piece of land too. And this is how we'll split our, profits. And so you're taking on all the drilling costs, which is going to be less expensive than me trying to be a small little operator walking up there to that tiny area and funding my own drilling. So
Yeah.
that's where
Yeah.
in oil and gas, I like partnering with large established firms who have hundreds of thousands of dollars already invested in the research, and they are already drilling in that area that we choose, and we invest in the mineral rights for drilling oil in that small area.
Got
That's
it.
one big thing. But the other big risk is just the commodity pricing. Oil is a very, very volatile commodity. It went down to zero during COVID. So you can't look at it as the day-to-day fluctuations of oil and start to panic. You've got to have that long-term view. Just like with interest rates going up and down, ICE raids are happening in my multifamily. Suddenly 10 families are gone. My occupancy drops, right? So all of that is what I call fluctuation. So you got to look at it as a 6-month, 12-month kind of view, and you can't panic. And you've got to look at this again as a long-term investment, like 5 to 7 year horizon at least. And a lot of it is dependent on crude oil prices. So we have a break-even occupancy for multifamily. Just like that, we have a break-even oil price. Our drilling costs, we need something to be in the piece for us to break even. So if it falls to zero and stays at zero for more than a year, yeah, we have a problem.
Yeah.
But what is the crude oil average price? It's in the 60s. How much more can it go down? What is the demand for oil? So what's interesting is big companies like Best Ever, which was the guru for multifamily syndications, the best ever conference, everything, they're all getting behind oil. So if you look at their newsletter today, they had a big webinar today just on the demand for oil, because a lot of people think of oil as just, hey, me filling gas, and what if I switch to electric? What if every one of us drives a Tesla? Is the demand going away? But the fact is, oil is everywhere around us. It's in all the plastics, it's in so many medical applications, etc. So all around us, our everyday life revolves around things made with oil. So the demand for oil is not going away if a portion of our population shifts to electric. So that is something people need to know. But the other risk of oil is the quantity of oil per well is unknown. I can tell you we have drilled, we've found oil, but I can't tell you how much is well 1 going to produce versus well number 5 over the next, 6 to 7 years. But oil wells peak production starts around that 18-month time frame to about year 6. That's your peak production of oil. So by the time year 6, year 7 rolls around, in our deals, you should have gotten at least double your money back in that time frame, maybe more. So if crude oil price goes to 75, 80, 85, yeah, you could easily triple your money in that time frame. So again, we have a sliding scale where we show how the crude oil price is going to affect your total returns. But right off the bat, your immediate benefit of that tax benefit, that's a sure thing. Sure. And then the quantity of oil is an unknown. Crude oil price is an unknown. Always go with the bigger companies that have massive amounts of money invested in the drilling. So there's vertical drilling and there's horizontal drilling, and they have the equipment. The other risk is when I buy real estate, I have an address, I can check the county record. I know that when I wired money to buy property ABC, I can verify it.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.